The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst Nick Cummings. Geez, I almost forgot your last name there. Nick, how you doing?
Morning, Gaurav. How are you?
And Graham is also with us from Vancouver. Hey, Graham, how are you?
Hey, Gaurav.
Okay, I'm going to set a record right off the bat here. Happy New Year to everyone. This is our first poddy for the year, and I think, for me personally, but I'll tell you your stories, definitely the latest New Year I've ever heard.
We're a sixth of the way in.
Ooh,
Yeah,
I know.
Past reporting season.
Is it? Have you heard of one later than that, or have I just got the record there? I can't imagine anyone's done one later than March. It's pretty bad.
No, I think you take the Coke.
I'll take it. The reason for that is a couple of us were on holidays in January. We had reporting season on February, and we've been doing internal things like hiring staff as well. So we just haven't had a chance to sit down on the podcast, but we are here now, and we'll be here fortnightly if all goes well. Right, guys?
Yep, we promise.
Gentlemen, we've just finished reporting season. I thought for today's inaugural 2024 episode in March, we could run through a couple of interesting stocks that we covered during the last month. I have to say, this was one of the most eventful reporting seasons I've seen from my personal portfolio. Those stocks going up 10, 20% in a day. I didn't have any disasters this time, although plenty of stocks fell as well. But the ones that rose, I thought it was interesting that I didn't think the results were actually that good. I just think the starting prices and the market reactions were excessive. We'll get through that in a minute. But Nick, let's begin with one of your businesses. Which company did you want to bring?
Yeah, I think the first one I'll talk about is Dicker Data. Probably to your point there, the result was, I think, fair to good, but not outstanding. The share price reaction was kind of just muted. It sort of just went up a little bit and then came back to where it was. I guess the main thing that I took away from the result was last year they had all these issues around. They were hoarding inventory because supply chains were pretty challenged, and they didn't want to impact their customer service that's won them so much market share over the years. So they took a lot more inventory onto their balance sheet, and this forced their interest expense to rise on their working capital facility. And that forced them to cut the dividend, and their profits sort of flatlined. I guess the worry, even up to 6 months ago, was if we got an economic downturn, that they would be forced to discount this inventory to move it, and that would just crush profits. This is a business that operates on razor-thin margins, like we're talking 10% like gross margins and maybe 3 or 4% profit before tax. So if that happened, it could have really smashed the bottom line. The good news is it didn't, and the result looked pretty good. Revenue was up about 5%, profits up about 10%, and usually Dicker Data grows at around double digits on the top line, so it was a little bit weaker. But the main reason for that was PC sales fell 15% because in the pandemic, a lot of businesses transitioned to work from home. They went out and bought a bunch of laptops, and now Dicker Data are lapping those higher sales. So I think that was a fairly good excuse. The company was also pretty bullish on PC sales coming back towards the end of this year and next year. So they're not only cycling, about to enter an upgrade cycle. So that's every about 2 to 4 years these need to be replaced. It's also what's also happening. Is artificial intelligence is now getting embedded into PCs. So Microsoft just recently made the first change to their keyboard in 30 years, introducing the Copilot button. So this is expected to drive sales in that category and Dicker Data's other categories like networking, servers, software. So the company's position, they've got through this, this challenging period, and they're positioned pretty well into the future.
Nick, Dicker Data always worries me a little bit. I look at it and I'm always a little bit frightened, but the track record of the business is astounding, and I love the way the incentives for management work. I mean, you're talking about a business here with with a whole bunch of working capital and debt, and that makes money by turning inventory over really, really fast and being super efficient with working capital. So there's very little margin for error in this company. And it does make me nervous. They pay 100% of their profits out as dividends. It's extraordinary for a business like this, which I probably wouldn't do if I was running it. But it just seems to work. I mean, it breaks a lot of rules. If you were there with a checklist, you probably wouldn't be ticking many boxes, but it does work.
Yeah, it does. And I mean, this is a business that they've gone through multiple cycles. Like, it's been around since the early 80s, been listed since I think 2010. So they've gone through multiple recessions, pandemics, and then the tech boom and bust at the turn of the century. So I think they know what they're doing. They seem to be excellent operators. I think, as you said, the incentives in place are terrific. And then I agree, the dividend payout ratio is 100%. I think the CEO, David Dicker, he has a few hobbies, likes his cars and
boats,
starting
well.
a racing team. So he needs that regular paycheck.
Incredible. It does show, I think, the limitations of that checklist approach. A lot of investors reckon that you need to see specific qualities before they're ready to buy a stock, and I just think that's probably the wrong approach to take. Decent. I mean, a safe business will tick all the boxes, but an outstanding business will break rules and do things unconventionally, and this certainly does things unconventionally. So yes, so it's a great business to bring to the table. I think since you came aboard, Nick, we've started coverage of it, and I've learned a lot about it. Actually, it's fascinating. Graham, is this one on your watch list? Do you own it? Do you want to buy it?
Not really. Yeah, no, I don't own it, and
it's too scary.
A little bit. Yeah, maybe. I mean, I'm not a checklist investor, but I can see that it does serve a purpose for, I don't know, weeding out some stuff. In this case, maybe I did miss it, but yeah, I don't mind a good checklist when it comes to investing, at least so you don't miss anything that's, I don't know, screamingly obvious that you should be avoiding it for.
I remember you were kind of banging the table on this at about $8, Nick, and I came very close to buying it myself, but just couldn't pull the trigger. I just got nervous. I just didn't know the business all that well. And there's a nice, 50% gain there that went bigging. So another time, another cycle, perhaps.
I think at the beginning, I was even skeptical of the name. The name just sounded fraudulent or a scam or something. And I thought, this can't be a real business, but I was proven wrong.
Look, I wanted to bring up a stock I've been banging the table about pretty much every meeting and every chance I get, which is Lovisa, which a bit like what you were talking about regarding Dicker, Nick, I didn't think the result was anything special. I mean, it certainly wasn't bad, but it was completely in line with expectations. I think we were talking about sort of earnings per share, about $1 per share for the full year, and it looks like they're going to probably exceed that a little bit, but it's not a huge deviation. But the stock price has just gone bonkers. It's probably up 50% in during the month of February, and I think that reflects just chronic mispricing. I was saying to the team that under $20, $18, $17, this is just a sell everything you have and go buy it. I call it a cereal stock, which means you stop having breakfast. You have everything you eat comes out of a box, and the savings go into buying more stock. And Lovisa at that price was a cereal stock. And yeah, I treated it like that. I was, week to week, every dollar I had was going into it. And they proved to be fortuitous. There's nothing really extraordinary about the result. A few things I will point out, and that is that management is not pandering to the analysts. One thing that I find hilarious at every analyst call is that most of the questions, in some way or another, express disbelief about the performance. And they really want to know, the analysts really want to know, how many stores are you going to open in the new year? How many stores are you going to open next year? They want a consistent store rollout so they can plug it in their spreadsheets and come up with an answer. And that is the opportunity, because management say the same thing every year. We will open stores where it makes sense and when it makes sense, which means they will do it on a store-by-store basis, which means it can be lumpy. In some years, they may open more. In some years, they may open less. It can be inconsistent. but it's happening fast and it's happening everywhere. And I think that really frustrates the analysts, and it leads to consistent mispricing of the stock, because this rollout is really happening quickly, and the trajectory year to year isn't really that important. Because I think we're going to be here in 5 years' time, and it's going to be thousands of stores, not just hundreds of stores. So I'm still pretty bullish on that. I do think the share price has run away a bit, and I wouldn't be buying here. I mean, I think I upped the buy price a little bit, but we're still way above that. So just sit tight and be patient with that thing. But I'm pretty bullish on it still. I think the numbers are all working, the strategy is working, and the one thing we have to keep an eye on is just the pay negotiations between the CEO and the board, because the CEO has extracted a lot of pay, and it sounds to me as though the business is not prepared to repeat that again and again. So we just have to keep an eye on that a little bit. But I'm pretty happy with the way things are going. Now, guys, did you, after all my banging the table and talking about it every single week, please tell me you bought some Lovisa?
I've regretted it ever since it was at like $3, not purchasing it then. But I must be one of those analysts that just don't get how it's doing it. I wouldn't have a case that it's overvalued, but I don't see why it can roll out these stores at that pace with that kind of business model. Because when I look around, there's tons of competition. What does make Lovisa special?
What makes it special is that it's special, Graham. You're thinking way too hard about
I've never heard a good example. I just haven't heard a good argument for why it is special. When I see it up against these other small, sellers like that, to me it seems very similar. So I know you've mentioned before that they have this strategy of kind of, they're planning, because of their scale, they're able to plan in kind of direct fashion in ways that other retail jewelers can't do. But yeah, I don't know. What do you sum it up as in a single sentence? Why is Lovisa able to do this when a smaller competitor can't just copy what they're doing?
Well, it's not just one thing. We remember the business has been around now for a long time, and there's been ample opportunity. There's been bigger and better resourced incumbents, and Lovisa has sent them all to the wall. I mean, Collett's gone. The couple of competitors in the US just aren't doing anywhere near as well. One of them had to pull their IPO because the numbers weren't working in their favor. It's a bunch of small things. It's being able to roll out new designs very quickly. So they'll release about 100 new designs every week. It's the careful targeting of a fast fashion market. So the aim is to just turn inventory over extremely quickly. And it's incredible store economics. So every part of the store is thought about, and nothing is under glass. So there's no labor component to any of the sales. There's only one or two people working there. The stores are all 50 square meters. I mean,
why isn't that replicable though?
Well, you can replicate the store size. You can replicate the number of people working there, but you can't replicate the designs. And every store that Lovisa has, they keep track of everything that sells, and whatever is selling, that data gets shared across the entire network, and then they're able to feed that information back to the supplier and back to their designers. And so there's this amazing feedback loop that just gets strengthened as the network grows, where they know what's selling at any point in time, and they can design more of it and ship more of it out. And that's what's difficult. So just think about if the three of us are going to open a jewelry store, what are we going to stock it with? Like, yes, we can probably find a cheap supplier, we can find some rent, and we can find some staff. But what are we going to put in there? Where are we going to get the designs from? We can hire a designer, but we're really just basing everything on luck. We're hoping that they're able to hit something that sells. Lovisa's design strategy isn't based on hope. It's based on existing data that's feeding into the central design hub. And the strength of that data, the scope of it, just gets bigger and bigger the more stores they roll out.
And I guess now that, what was probably once I saw as a risk, which was a couple of years ago, this international rollout and how it was going to go, is maybe now an advantage when you come back to the data they're getting, because they can actually spot trends from all around the world and incorporate that all into the one system, whereas, a local competitor can't.
And they're just astonishing at inventory management. I think the thing that amazes me most is, I think about the logistics of opening 150 stores every year. That means they have property teams scouting out 150 locations. They have HR teams hiring staff for those stores, training them up. They're able to implement sales systems very quickly, and then they're able to move inventory around to stock those stores and restock them. I remember they get 100 new items every week. So as the network grows, their distribution and inventory management has to grow with it, and they've never skipped a beat. Like, that is an amazing machine. And it might sound simple to open stores, but to get all the back end working and humming the way it is no easy task. This is an astonishing achievement. And I don't know.
Yeah, it does seem like a machine that just, I don't know, can keep rolling out its game plan, and it seems to work.
Yep. You guys don't want to make money. You guys just don't want to get rich.
Every time you talk about it, Gaurav, it sounds like a love poem.
Well, it is. It's now, for me personally, it's been my largest position for a while, and it's now approaching coal. Like, it's the scale of the investment is now kind of starting approaching coal levels, and it's just you don't often find opportunities that you can really get behind and sit in and compound and do it without taking a whole bunch of risks. Remember, there's no balance sheet risk here. This is net cash. They're paying a 3% yield while they're growing one of the fastest rollouts on the ASX. It's just extraordinary, right? I don't think I've seen anything like
amazing.
It. Yeah. All right, Nick, what else do you have? Hang on, we haven't got to Graham yet. Graham.
Oh, we haven't got to Graham, yes.
Yeah.
I bring Sonic Healthcare, the other love story, to the table.
Yeah, you have your baby and I have mine.
Yeah. Well, unlike one of these cheap Lovisa stocks, this one had a 50% decrease in net profit this year. But
is that because it's still cycling COVID numbers? Or
yeah, that's exactly right. The stock fell 10% when it announced this, a 47% decrease. And it totally, that really surprised me, because all of that decrease was down to a 90% drop in pandemic-related revenues. When you look at the underlying business, like, if you didn't have that overlay of pandemic revenues, this would be one of its strongest periods, I don't know, in at least a decade or two. The organic growth being achieved by Sonic at the moment in both the Australian market and the US market, its two largest divisions, is at kind of 9%, which is, just way above anything that it's been historically. So something has really changed in the pathology industry, I think, since the pandemic. And it's just churning out more and more tests. Maybe it's the aging population, or I don't know, different pricing structures, whatever it is. There's more tests that are being done at higher prices, and it's definitely benefiting Sonic at the moment.
Can we just talk about the competitors for a second? I noticed that both major competitors, just remind me of their names again, ACL, who's the other one, Graham, the number 2? Helios. Both of them are hopeless, right? Helios is a basket case and has been for a while. ACL probably subscale. The ACCC has by not allowing them to merge. How much?
I feel a bit sorry for ACL that they aren't able to merge, because I think that merger was really its like cry for help.
Yes, I agree.
Yeah, I don't think that it's going anywhere really. But I mean, Helios is a big competitor, and when you look at just its pathology division, that it's a pretty worthy competitor. I can't remember off the top of my head what its market share is, but it's certainly up there. It's basically just Sonic and Helios who are running the show, and then ACL comes in with a very distant third place. So anything Sonic can do, I think Helios should be able to do if it was just perhaps managed a bit better, or I don't know, controlled its costs a little better.
Yeah, no, the management doesn't seem particularly good at Helios. Yeah.
Yeah, I think they've always been a bit distracted by their the GP business, and so maybe the pathology just didn't get the attention it deserved over the years. I think they did a pretty good job despite that.
I think that's why there's always constant chatter about the breakup of Helios, and I think it makes a lot of sense.
Yeah, so do I.
The old primary business away from the pathology business. But that would make more sense if you could then merge the pathology business with ACL, which the ACCC has gone kind of bonkers the last few years. Every deal I see that come to the ACCC just seems to get an automatic block now, and it's just strange. The aggressiveness shown by the ACCC is just seems a bit kind of weird. But that's one deal I reckon that should get done. And won't get done.
No, I don't think so. And they, in this case, they possibly have I mean, it's also looking from the ACCC's position. This is really their only chance at blocking a complete duopoly in the industry. It's already basically a duopoly, which is why I think that they probably should have just. I mean, the industry was moving in that direction one way or another, and so they might as well have just helped it along a little bit, so that at least there are two kind of equally matched competitors. Whereas by blocking this, it's probably just going to lead to Sonic's advantage because Helios isn't able to keep up at the moment. ACL will, I think, drop out of the race over time, and then we'll be left with potentially kind of Sonic as almost a monopoly if you look in the far distant future.
To what extent, Graham, is this pathology industry tend towards natural monopoly? I mean, is there a case that that Sonic will just get 90% of industry profits, the way kind of Apple has, the way that Apple has competition for the iPhone, but they just gobble up all the industry profits? Is that the same for Sonic as well?
I don't really see that happening at the moment. I think it certainly tends towards, and you can look at all the different markets it's doing this, tends towards an oligopoly or a duopoly. I think there's room in any of the large markets for there being multiple providers. So in the US, one of the largest, it's got at least 3 or 4 big ones, of which Sonic is a competitor. But yeah, if you go to any of the other kind of medium-sized or large markets, it's always just a few big guys at the top. In smaller markets, maybe even Australia would count as this, but I'd be thinking more kind of New Zealand size. There's possibly a case that it would cascade towards just a monopoly because the economies of scale are just so strong within this kind of industry that the leading provider does tend to have a pricing advantage over the rest, which then attracts more of the referrals from there.
Yep.
So it does kind of cascade towards a single provider in small markets and otherwise an oligopoly in large ones, I think.
Nick, thoughts on Helios and Sonic? Have you ever thought about either of them?
No, I must admit I've never really looked at either of them. I agree with some of Graham's thoughts on the economies of scale. Some of the international companies I've looked at testing, industry. It's just lots of fixed costs, and it's just about putting as much volume you can through that through those centers. So tends to, like, I think about it as the dominant player should this keep getting more dominant, and it's sort of back to Graham's point. It's a bit odd that they're blocking a merger that could maybe create a really strong second player that could compete with Sonic, and maybe Sonic now just gets more market share as the other two sort of fall away. It's probably the opposite of what they wanted.
It's also interesting, I think, because it's one of the few areas of healthcare where productivity has grown so much over time that it's actually saving the government money to have these large players. So because they do run much more efficiently as a small market of just a few large companies, they end up saving the money. They end up saving the government money because as they get more efficient, they become more profitable. But then the government can step in because it's usually a single payer system. So Medicare is able to set prices. Then they can lower those prices and then suck a lot of those profits back into the government's healthcare budget. So I think as governments get more and more strained with their healthcare budgets, because every other part of the healthcare industry is just experiencing all these cost blowouts, at least with pathology, the government can potentially save money in the long term by allowing these oligopolies to form.
Just looking at the returns from Sonic, though, Graham, this doesn't seem to be a monopoly that's milking supernormal returns. I mean, the return on capital,
it doesn't.
Is okay. It's not bad, but it's just not great.
Yeah, and that is the downside of this sort of monopoly, is that because you essentially have just one customer, which is the government, at least paying the bills, then that does kind of open you up for that customer to take the excess profits. So I think it's because it's such a critical part of Australia's kind of healthcare infrastructure, it would be ridiculous for the government to squeeze it to the point that it becomes unprofitable or fails or something. It would be just hugely disruptive to society if that were to happen. So I think you can think of it almost as an infrastructure stock where the government has an incentive to let it earn a decent return, but not to earn crazy monopolistic returns.
Yeah. And that has implications for the multiple we should be prepared to pay for a business like this, right? It probably doesn't deserve full monopoly multiples.
Yeah, no, this isn't an Apple kind of stock. It's you've got to compare it against things like probably Auckland Airport or something like that if you're wanting to think about what kind of multiple it deserves.
Yeah. Okay. Interesting. Nick, we're back to you. Let's pick up another one. What do you got?
I've got Seek, which I thought was a pretty bad result, but as we sort of said at the start, a lot of the really, good average results, they were up 10, 20%. No, as you said, Lovisa up 50% over a month, whereas Seek was, I thought, a really poor result, and it was down initially and then just flat. But I was surprised at just how forgiving the market was with it. So their job ad placements in their core market, Australia and New Zealand, declined by about 20%. That was offset by some price increases, but that led to the largest revenue decline in a first half since the financial crisis. And I guess you could just say that this is a cyclical business to a degree, that job ads go up and down, which is, definitely there's definitely an argument for that. But the more I look at this business, I just think it's really, really complex. I think it's by far the worst out of the three dominant classifieds business.
Oh, wow. Okay.
REA is probably the best.
Oh, definitely the best. Not probably.
Definitely the best. Yeah,
surely.
Yeah, exactly. Car sales, they're in 4 global markets now, but they have market shares that are multiples of the competition in each market. Whereas if you look at Seek, it's just extremely complex. So they've got this Asian business, which is in about 6 to 8 countries. There's emerging countries like Indonesia, Thailand, and Philippines, all have different market shares there. Then there's developed countries like Hong Kong, Singapore, and Malaysia, and they have market shares there that are far below their dominant position in Australia. And so I just don't know really how to view it. It's not like they're taking the Australian New Zealand model and just exporting it and having a dominant position in these markets. They've sort of got challenged by other competitors there, and it's just overall very, very complex. Made even more so by this Seek Growth Fund that they've spun out. They've done some accounting treatment there in their earnings they exclude the management fees they have to pay on that, which again, it's not
real cash out the door.
It's real cash out the door.
Yeah.
But I by far I think this is the weakest out of those 3, and this result has made that more clear in my eyes.
Yeah, it is the complexity you're right about. The thing I find difficult with Seek is that it's part dominant classified and it's part venture capital fund, and just all that is in the same vehicle, which makes very little sense.
Yeah, and that's like REA's, I think, success over the years has been their lack of ambition. Sure, at the moment they're expanding in India, and we'll see how that goes. But they've just been able to milk the Australian property market for all it's worth. Return cash to shareholders, buy adjacent assets like mortgage broking, and that. And whereas Seeka's sort of taking all those monopoly-like profits in its core Australian New Zealand business, which is fantastic. Having all these other bets, overseas. I didn't even mention that they've got assets in Brazil and Mexico that have been sort of underperforming for a number of years. So, it's probably, and sorry, this last point, it's at 35 to 40 times earnings. So it's not like you're getting a massive discount to the other two as well.
What's REA trading at now in terms of multiple?
It's up there. Sorry, it's probably 50 to 60.
Okay.
Car sales is probably around 35 times earnings, though.
Yeah, that all seems very rich. I mean, we know REA is wonderful, but 50 times earnings for a business where the growth really comes from price increases every year, doesn't it? Unless India really kicks off.
Yeah, I think that's the. I think at these prices you probably need India to work, but. Then again, it's always looked expensive, and who knows, we might be sitting here in 7 years and the median property price in Sydney is $3 million, and no one thought it'd get past, 1.1 million or whatever it is now. So who knows? They've certainly got plenty of pricing power there.
Yeah. Well, real estate agents take such a big chunk of the transaction pie, and REA takes such a little amounts of money in comparison. But all the value gets really generated by REA. And so I think there's a lot of transfer still to happen as REA just takes more and more of of that very large transaction. And the bigger the transaction, like the higher property prices, the more dollars REA can legitimately squeeze, I think, out of that, out of the ads.
Yeah, absolutely right. I mean, just read it the other day, just a little stat on the real estate industry, which just, completely blew my mind. And there's about 130,000 real estate agents in Australia, and we have 90,000 in our defence force. Like it's just amazing how much this one asset dominates our, it's almost ingrained into us. It's crazy.
That defence force number always surprises me.
Yeah, I was shocked by that as well. That's
when I think they could all fit in a Taylor Swift concert.
Yes, that's right.
It just seems very small.
Yeah,
that'd be an interesting
and we're defending a continent.
Yeah,
the Swifties versus the ADF. I don't know. Yeah, I probably put my money on the Swifties.
Mass mobilization.
I think it's hilarious that that real estate agents are able to charge sort of 2% of the transaction, and they come to your house and open the door, and that's mostly about it. And then the search function and the matching of buyer and seller is actually done by REA, and their cut of the transaction is got to be a tenth of that, right? Like 0.2%.
Yeah.
I look at that and then I think, well, there's probably a lot more room for REA to get more of that transaction value. And in dollar terms, it's just growing and growing. So I look at that 50 times earnings, and it's quite. It isn't impossible to justify that. It is a reasonable person can probably come into a determination that's it's a reasonable price. I haven't quite got there myself yet, but I've missed out for years on REA. It's every time the market falls, it's the stock I go to see if it's ready. If I haven't buy it and I haven't bought it.
I think my sort of issue, I guess, with REA is, what's your advantage with it when you come to it? And every time the market falls, it seems to fall, less because, as you said, everyone rushes to it.
Yes, that's right.
If you polled every investor in Australia, they're going to put up there as top 3, probably number 1 best business, and everyone knows that. So it's always a struggle, to know, to understand what your advantage is there. Maybe it's just patience and willing to hold it for decades.
Yeah, I think that's exactly it, Nick, because the way these analysts do their valuations and models, they put REA on growth rates that it deserves for the next 5 years. And after that, it just gets market growth. So if you're prepared to hold for longer than 5 years, then you get the growth rate you'll get out of REA will be much higher than what what's priced into the stock. So I think that's the key to it. You got to hold it for a long time. All right, I got one. What should I do? I was thinking about Aussie Broadband. Actually, was something that most results when we come to them, we generally have a pretty decent idea of what to expect. I probably look at a business and think, okay, I think I know what it's going to do. I kind of know roughly how much money it's going to make or what it's going to do. And then every year, Aussie Broadband, I come to Aussie Broadband before the result, and it's always one that's a blank in my little Excel sheet, because I don't really know how much it's going to do. Because the business is now getting increasingly complicated and it's hard to predict. But B, because there is so much corporate activity now that is engaging, and you just don't know what's going to throw up. So last 3 years in a row, they've just come in with a big surprise. The takeover of Over the Wire, and then the takeover of the old, what's it called, Nick? The
MyNetphone.
MyNetphone. What's it? It's got a different name now.
Symbio.
Symbio. Thank you. Then the takeover of Symbio, and then this year. And I was on the call, and I heard the management talk of, and there was not even a hint that they were going to be launching their biggest acquisition yet, which is of Superloop. Now, so the business is changing quite dramatically and growing really well. I was really impressed. The market share gains have been much, much larger than I would have thought. When we first recommended this stock sort of at IPO, it had, I think, a 2 or 3% market share. And back then, we sort of talked about in the Dragons, and we spoke about them potentially getting a 10% market share at sort of maxing out. They will get that next year. They will hit 10% market share, and most of that is organic growth. That's not from acquisitions. What's interesting about Aussie is that the acquisition strategy is not about buying customers. It's really about buying either physical assets or capability. So Over the Wire and Symbio was about buying a voice network. Instead of leasing a network, they can then own a voice network, which gives them more control, more product features, and it lowers their cost. And they've really managed the integration of that piece of technology quite beautifully. And then with Superloop, again, they're not buying customers there. The idea really is for Superloop has a whole bunch of fiber that it has not used optimally, and it doesn't really know what to do with. And I think that fiber inside the hands of Aussie Broadband, where they're able to attract a lot of customers, and they're now doing enterprise, wholesale, and corporate services, that fiber will be used better. So I'm behind that deal. I think it makes sense, but I don't think the market has quite twigged that this is not about buying customers. This is not a roll-up, even though that's exactly what it looks like. That's not what's happening. They are quite carefully and selectively buying capability. And that's all about transferring the business from a reseller of the NBN services onto something a lot more higher margin and sticky, which is, as we've said before, that's the transition that Macquarie Telecom made more than 10 years ago. And we're seeing it unfold again in Aussie Broadband. I think the management here is fantastic. That was really the investment case, that these three guys out of Victoria fought 100 competitors with no advantage and still came up on top. There's clearly something special going on in that business. And I think that remains the case today. So as long as we see those key personnel, particularly the MD, Phil Britt, and he did sort of hint he was thinking about resigning, but then he came back this year and said, no, I want to stay for another unspecified period of time. As long as he's at the helm, I'm quite happy to hold this, even though they are, they're growing and expanding and taking things over, which can be a warning sign. I'm feeling okay about that. The balance sheet's also in pretty good nick, so I'm okay.
It's another example of, one of these hyper-competitive industries, sort of like we were talking about with Dicker Data, where customer service is wins out. It's sort of the opposite of what you look for, don't you, as an investor? You're looking for quality, big moats, and at least in the reseller side, this business's moat is pretty much customer service that's better than the competition. It's kind of amazing.
Completely agree. And I actually think that's, for me, increasingly, that is that's the new competitive edge. That's the source of ideas, because everyone knows now about moats. And how many investors now talk about moats? I mean, 10 years ago, probably not as common.
Network effects.
Network effects were two words you'd never put together a decade ago. And now any investor, even a complete novice, will tell you about network effects. So all these well understood competitive advantages, they're just priced out, and I don't think you get rewarded for selecting them anymore. So you really got to find businesses that look like they have no moat, but actually maybe have an internal moat or just do things better.
And you're able to find them, I feel like, a lot cheaper than as soon as a business, particularly on ASX, gets tagged as a quality business. I feel like there's just an extra couple of points to its valuation you can add. So
extra multiples. I mean,
I was being kind.
Pro Medicus at like 150. I don't even understand the value. I cannot make that valuation. We got to make some heroic assumptions to make that work.
Yeah.
There's a couple of others. REA, we sort of talked about. Xero, I still think is, I think that's overpriced. I can't really make that work.
Yeah. WiseTech, I think.
You needed a lot to work.
Right,
I don't know, Nick. I can see for WiseTech to work, it has to become the winner takes all, which is possible.
Yeah. I think it's, I might go out on a limb and even say it's probably likely at this point. It's just, what are you paying 90, 100 times? I mean, it can only grow it because it's got to onboard so many customers a year, and that takes time. It can only grow at certain growth rates. I get your point though.
Because WiseTech is what, a $30 billion business now?
Yes, it's probably something like that. Pretty close.
Yeah. But in the scheme of enterprise software, where the profit pools can be really big, it's probably not reflective of how big it can ultimately get.
That's true. The only thing about enterprise software is most is designed at most industries, if you know what I mean. Like this is specific to logistics companies, which is obviously a multi-trillion-dollar industry. But something like a ServiceNow or Salesforce is applicable to multiple industries or virtually every industry. So it's probably total addressable market. That's a bit of a buzzword, I guess, but it's probably a bit more capped than some of the others, I would say.
Yep, point taken. Speaking of ServiceNow, now that's a business I'd love for you to write about or talk about at some stage, because
I'll put it on the list.
Yeah, on the list. That'd be awesome. Sorry, Graham. Aussie Broadband, and also actually, Graham, the thing I wanted your input on was this idea that moaty businesses increasingly are not the best choices on the ASX. It's a pretty big, bold statement to make. What are your thoughts on that?
I think it's fair to say that they are probably more accurately priced these days. Like you were saying, that there may not be a big advantage to buying one versus a company that doesn't have a moat. But I still think you kind of need to buy them, because otherwise you're kind of really, throwing darts at a board for the valuation if it doesn't have one. So, like if your ability to value a stock depends on the certainty of earnings, or at least your clarity of what the earnings are going to look like over the next several decades, then how can you do that if the stock doesn't have a competitive advantage? So,
darts at a board. Yeah. Graham, you've uncovered my entire investment strategy. Let's come to you now, Graham. What do you have for your final choice?
I thought we could wrap up with a little bit about Coles and Woolworths, because they're getting a lot of heat at the moment with the pricing inquiries that the government and the ACCC is investigating, whether or not they're kind of taking advantage of the inflation at the moment to push through exorbitant price increases. And I can certainly empathize walking through the stores that it does feel that way when you're picking up whatever it is, a box of chocolates that used to cost 20% less just a couple of years ago. It feels like
now, Graham,
Coles and Woolworths.
Be honest.
Okay,
A
2
chocolate.
boxes of chocolates.
There you go.
Yeah, 2 kilos of chocolates.
There you go.
But it can certainly feel that way as the customer. But yeah, I'd like to defend them a little bit because the companies, even though it feels that they are increasing the prices a lot, they're not really taking advantage of the situation. If you look at their income statements, that these companies have had pretty stable margins all the way through the last 5 years. And so those price increases are just them pushing through cost increases of their own. So, I mean, if you hate that chocolate prices are going up, Coles and Woolworths are not the companies to blame for that unfortunate event.
Oh, okay. Let me play devil's advocate for a second here, Graham. How about
Good, we needed one.
Yeah. How about the idea that we don't notice? They haven't been taking advantage of this particular inflation spike because they have been taking advantage of us for decades, and we just haven't noticed. I mean, it is true.
I don't know.
The margins don't seem that high, but higher than industry average worldwide. And I would
not really. It used to be, but I mean, I made the point in the article, they make 2.7 cents for every dollar that they sell. So if you buy a $10, whatever, box of chocolates, they're only making like a 20-cent piece out of that as a profit. That doesn't seem unreasonable to me.
Aren't all these net margins more like 4%, right?
No, it's down at 2.7, under 3, and it's been like that for quite a while. They used to. If you go back, this is the irony, is that if you go back 5 years or maybe 6 or 7 years, they were quite a bit higher than they are today. And so I feel like, and higher than world averages. So I feel like there might have been a case, looking back 5 years, that they were over-earning and that maybe they were kind of milking their duopoly position too much. But I don't know why the argument is coming out. Well, I know why the argument's coming out now. It's because prices are going up. But it's not them that are, widening their margins and taking all this extra profits. It's ironically the case in Canada where the grocery companies are doing that. Profit margins have been increasing. But Woolworths and Coles, nope. I think they've been playing pretty fairly through the pandemic.
Do you think it's not the absolute level of profits, but it's the way that these supermarkets achieve them? Like they are quite aggressive in chasing down suppliers. Their returns on capital, Woolies' returns on capital, I was shocked when I checked this. It's like 20%, Graham. That is astonishing.
True. But that's a sign of efficiency as much as anything else. I think if you're trying to judge whether they're extracting too much from customers, that you do need to think of the margin more than the return on capital. And if they're earning kind of pennies on the dollar, then I don't know. I feel like you got to let them earn something. Not that I'm sure that's a popular belief, but yeah, I think you're right that because they kind of get a bad name for themselves with how aggressive they are with suppliers, which is probably true, that kind of makes the public view them as these big bad companies, but actually it's the public who have benefited more than anyone from their aggressiveness, that instead of it being, 10 years ago where margins were much higher, the aggressiveness between not only Woolworths and Coles and their suppliers, but between each other has meant that it's the customers who are saving all the extra profit margin, basically.
Let them eat chocolate.
Yeah. I don't know what the peasants are whinging about.
Yeah. I guess there's a bit more competition now than there probably was, 2 decades ago. You've got Aldi in the market.
Yeah.
Costco is becoming a bigger player as well.
Yeah, I think that was a changing, something that changed the market quite dramatically, Costco and Aldi coming in.
Yeah, there was a point pre-Costco, pre-Aldi, where Woolworths was the highest margin grocer in the world. And and that is no longer the case. I was playing devil's advocate, but I actually completely agree with you, Graham. The evidence is very, very clear, and I think your point's well made. I will quietly point to there is actually, and I wrote about this in Telstra's Telstra's review, but Telstra is now the highest margin mobile operator in the world. There was a Canadian, what's that Canadian one called, Graham?
Rogers.
Rogers.
Sure.
Yeah, no, Rogers was the highest margin, but Telstra has now taken over, and their operating margins are now higher. They're going to be over 50% next year, I recken. Which
Wow. See, there's a company that knows how to milk its position.
Exactly. That's where I was getting to. Like, if there is a monopoly that we pay every day for, it's just got to be Telstra Mobile. It's just an astonishingly good business. We might cover Telstra in a bit more detail another day, but I worry about that for the review with some strongly worded thoughts, which not appreciated by the company, I'm sure. Right. Gents, we've been chatting along for a while now. Anything else to add, Graham and Nick? What about, actually, Graham, while I've got you, I am a bit disappointed with the chocolate range at Woolies and Coles, for that matter. Got to get some better quality stuff in there. What are these Canadian?
Well, gosh, I was shocked when I bought some Hague's chocolates the other day. That has gone up so much in price compared to where it was a few years ago.
Yes, it has.
Yeah, I'm sure they're pushing through some extra margin. Well, I don't know their accounts.
Well, apparently,
I couldn't say,
but gone bonkers. The raw material prices have gone bonkers, and that's why chocolate now tastes just awful. They're substituting cocoa with sugar, even more than they were before.
Well, you don't hear me complaining about that. a little extra sugar never hurt anyone, did it?
Yeah, I think doctors have a T-shirt for that. That's right.
Yeah.
The diabetes awareness line.
All right, let's call it a day, gents. We'll do this again in a couple of weeks. Graham, thanks for your time today.
Thank you.
And Nick Cummings, I got your name right. It was great for you to join us. And what a shame we don't have any more videos, because it means it's the last of your famous filing cabinet.
I know. No, thank you both.
All right, give it a pat for me. We'll come back in a fortnight. And for everyone else, thank you for listening.